Good afternoon. Thank you for being here. My name is Andrew Eastman. I'm a partner with Husch Blackwell's Energy and Natural Resources Group. I work with clients mainly in renewable energy project development. A lot of that these days means the generation and monetization of renewable energy tax credits. And thank you all for joining us today. Before we begin, let me cover a couple of housekeeping items. At the bottom of your audience console, there are a number of applications for you to use during the program today. If you have any questions during the webcast, feel free to submit those in the question box. We'll try to answer all those during the webinar today. If we run out of time, or if something needs a more full answer, we'd be glad to get back in touch by email or phone. A PDF of our presentation is going to be available in the program materials folder, along with some other helpful material. And toward the end of the program, please be sure to complete our short survey. We use your feedback to plan future programs applicable to your business needs. That's all for housekeeping items, so let me get started with our program. Presenting with me today is Doug Jones, also of Husch Blackwell, along with Gideon Gradman, David Gibson, and Bob Hofacker of Baker Tilly. Doug is a partner in our energy group as well. Doug counsels clients in all aspects of tax law, mergers, acquisitions, joint ventures, workouts in and outside of bankruptcy, recapitalizations, divestitures, spin-offs, entity formations, and capital raising activities, and the tax underpinnings behind all of those sorts of transactions. He works with clients ranging in size from startups to multinational public corporations, and like me, a lot of Doug's work lately has been the generation monetization of energy tax credits. Gideon is a managing director with Baker Tilly's Development and Community Advisory Practice. He advises companies, asset owners, developers, and investors on energy markets, project finance, tax credits, and incentives, and on developing energy infrastructure and industrial assets. Gideon is one of Baker Tilly's specialists in the Inflation Reduction Act and its energy provisions, and he advises energy developers, universities, municipalities, and regional government agencies on energy development and tax credit finance. David is a managing director with Baker Tilly's Development and Community Advisory Practice as well. He's got more than 25 years experience raising and deploying capital in and for financial institutions. He leads the firm's tax credit investment syndication business. He collaborates with clients to raise and deploy investment capital for projects and businesses in the renewable energy and new markets tax credit industries. Finally, Bob is a director with Baker Tilly's Manufacturing and Distribution Practice. He specializes in providing tax compliance and consulting services to privately held businesses. He's got significant experience in partnership tax compliance, including in the context of private equity and renewable energy portfolio companies. With introductions out of the way, let's jump in, and thank you very much for being here. To sort of set the stage of where we are, we're going to be dealing with renewable energy tax credits, specifically those expanded or created under the Inflation Reduction Act of 2022, although some that are impacted by that act but weren't necessarily created by it. And the idea behind these tax credits is that purchasing a credit lets a company offset its own tax liability. It's typically not a dollar for dollar offset. Why would you pay a dollar in exchange for a dollar of tax credit? It's typically a discounted rate somewhere in the neighborhood of 80 to 96 cents on the dollar. And that range is going to change based on the riskiness of the credit, and based on the availability and desirability of that credit, including its recapture risk. But generally speaking, 80 to 96 cents on the dollar. In exchange for that, you'll get a dollar of tax offset. Credit sellers are looking to do this, right? This raises the question, why wouldn't you use your own tax credit for yourself? Typically because they have insufficient tax appetite to use the credit themselves. And what really they could use more than a credit on paper that's more than they can claim is cash in hand today. Sellers, for the most part, are renewable energy project companies, energy manufacturers, makers of renewable energy components, as well as utilities. So there are a number of different credits that sort of go into these transactions, and we're going to touch each one of these briefly and provide some background. The one that's most common, and maybe that everyone's got sort of the most basic kind of passing familiarity with, is the Section 45 Investment Tax Credit, or the ITC. It's a one-time tax credit, and it gets determined or generated at the placed in service date of the project giving rise to it. So when that project is placed in service, which is close to but not quite hitting commercial operation, this credit is generated, and it starts out being 6% of the qualified investment in that project. essentially 6% of the qualified eligible costs. Now that 6% can go as high as 30%. There's a 5x multiplier if the project hits prevailing wage and apprenticeship requirements. That multiplier there it can go higher still. There are further adders and bonus credits, but sort of base case that most people aim for and model around is the 6% with a 5x multiplier to get to 30%. This is a credit that's subject to recapture risk. We'll get into recapture risk later, but generally speaking, recapture risk means that there is a possibility that at some point, some part of this credit is disallowed. And that percentage is going to shrink over years and ultimately vanish after 5 years. But the ITC is one that's subject to recapture risk. The technology here, projects that give rise to an ITC, is relatively broad. Wind, most types of solar, a lot of geothermal, renewable natural gas, combined heat and power projects, offshore wind, microgrid, all of these are eligible to generate an investment tax credit under Section 48. Section 45 is the production tax credit, or the PTC. The PTC is a tax credit, and instead of being based on the amount of money that's invested in the building or construction of a project, the PTC is based on the production of that project, either the energy it puts out, or in the case of a manufacturing project making energy components, the value of the components that it puts out. The rates are going to vary based on what's being produced. Like the ITC, there is an adder here for prevailing wage and apprenticeship requirements. Unlike the ITC, there's no recapture risk. And that's one of the things that's going to make that PTC go for more money than an ITC. Without that recapture risk, it's the less risky credit, and so it commands a premium as far as purchase price compared to the ITC. Technologies that put out a PTC, biogas, biomass, hydroelectric, municipal solid waste, which is the sort of waste that goes into a lot of renewable natural gas projects, landfill gas, ocean thermal, wind, hydroelectric, all of these things that generate energy, that energy is going to give rise to one of these production tax credits. Section 48E is another ITC, this one being technology neutral. And that technology neutral, agnostic, so long as what it generates is clean electricity. This applies to qualified facilities and energy storage technology that's placed in service after 2024. So January 1, 2025 is where we're looking here. A qualified facility is one that's going to generate clean electricity. And here's the kicker, it's got to have a greenhouse gas emissions rate of not greater than 0. It can be 0, it can be less than 0, it cannot be greater than 0. Like Section 48, this starts at a 6% basis. There's a 5x multiplier. You can get up to a 30% basis if prevailing wage and apprenticeship requirements are met. Like 48, there are some additional credit adders, and there is, again, a recapture risk. This is a credit that's going to start in January 1 of 2025 for those projects. It's going to phase out and end by 2035. So we've got some time for projects to be placed in service or to begin construction to earn this credit, but it's not going to last forever. 45Y is a technology neutral PTC, so another production tax credit. This was created, added by the Inflation Reduction Act, and it's a clean electricity production tax credit, as opposed to other sorts of energy that might be produced by a green energy program. And the idea here is that it's a credit generated by a qualified facility placed in service after 2025. So again, we're looking January 1 of 2025 and on. I should have said placed in service after 2024. And similar to the 48E credit, this is going to be a project that generates electricity and has a greenhouse gas emissions rate not greater than 0. This is another 5x multiplier that's available if prevailing wage and apprenticeship criteria are met, and it does not carry any recapture risk. So the recurring theme you'll see is the ITC, the investment tax credit, comes with a recapture risk. The PTC, because it's a snapshot in time, depending on when that energy or when that component is produced, does not come with a recapture risk. 45X is a certain type of production tax credit, a certain type of PTC, and it has to do with advanced manufacturing. And so in the case of the 45X, as opposed to putting out energy, what you're putting out is some sort of component that goes into a clean or green energy project. Batteries, mineral components, inverters. The things to be aware of here with respect to 45X are that the components have got to be produced and sold after December 31 of 2022, phasing out in 2030. And it's ultimately not going to be available for components sold after 2032. The credit amount is going to vary depending on the sort of component that's produced and sold, and it's going to be judged on a per component basis. 45X is one that sort of rounds out the general categories of tax credits available. 45Q rather is a credit for carbon dioxide capture and sequestration. This is the carbon capture, use, and sequestration credit. And it wasn't created by the Inflation Reduction Act, but rather expanded by it. This is essentially a PTC, although instead of rewarding you for the production of carbon, this credit is meant to reward you for or incentivize the capture and either sequestration or qualified use of carbon dioxide. The rate depends on how that carbon dioxide, those carbon emissions, are used or sequestered. When carbon's collected out of a project or out of the air, it can either be sequestered or it can be used for something like enhanced oil recovery. And the amount of the credit is going to depend on the ultimate use to which that carbon is put. Like the ITC, this is subject to prevailing wage and apprenticeship requirements. So there is the possibility of that multiplier there. And the project has got to begin before January 1, 2033. And that means begin construction before that date. And there are certain IRS factors and certain tax guidance that'll help us figure out what it means to have begun construction, quote unquote, for tax purposes before that date. 45Q, unlike other PTCs, does have its own recapture provisions. 45Z is a clean fuel production tax credit, a PTC. This has to do specifically with renewable fuel that's used as transportation fuel. It can be used either in a highway vehicle or an aircraft. It needs to meet certain emission standards and other requirements. And assuming you meet those requirements, this PTC is available for fuel produced after December 31 of 2024. And it's got to be sold to an unrelated party through December 31 of 2027. It's got to be transportation fuel. And this is one, although it's a PTC, prevailing wage and apprenticeship requirements do apply. 45V is the production tax credit that has to do with clean hydrogen. The qualified facility generating the hydrogen has got to produce it after December 31 of 2022. And construction of that facility has got to be begin before 2033. After that, new facilities are going to stop being eligible here. Prevailing wage and apprenticeship does apply. And this is a unique sort of credit in that it qualifies for direct pay. Direct pay is something we'll get to a number of slides from now, but the general idea is that when a developer, a project entity, a generator of some sort has got a tax credit, and it's going to sell that because it can't use the credit against its own tax liability, it's going to sell that at a discount. It's going to sell it somewhere for 80 to 95, 96 cents on the dollar. Direct pay is a concept whereby instead of using that credit yourself and instead of selling it, the generator is able to take that credit and essentially hand it to the IRS and treat it as a prepayment on taxes, at which point come year end, the IRS looks at that credit and says, well, it looks as if you've prepaid too much tax, and so we're going to pay you back in the form of a refund. This is a great mechanism because you don't lose any value of that credit to the discount in a purchase. So you're going to get 100 cents for every dollar of credit. Big question mark is when, how quickly the IRS is going to cut you that refund. With that said, let me turn it over to Doug Jones, who's going to provide a lot more detail about these prevailing wage and apprenticeship requirements.
Thank you, Andrew. Pleasure to be speaking with you all today. So as we discussed, the prevailing wage and apprenticeship requirements are really important. They are what gets you from 6% to the 30%, and pretty much every deal treats them as a necessity. There are exemptions for certain projects. One is for projects that began construction prior to January 29, 2023. So if you have a project that began construction prior to that date, you're exempt from these requirements. A lot of the credits that have been transferred in the marketplace have benefited from this exemption. But as time goes on and as we get further away from that January 29, 2023 date, more and more projects are not qualifying and are going to have to be thinking a lot more about compliance and substantiation. We're going to have quite a few in-depth slides about those topics later. As far as just the basic requirements are concerned, in order to begin construction, beginning construction is a term of art in the tax law. The concept comes from some notices and other guidance that the IRS has put out. And there's two ways you can begin construction. One's a physical work test, where you actually physically perform some work. You dig a foundation, you start bending metal or cutting wires on some custom piece of equipment, either on-site or off-site. And that physical work of a significant nature is when one way to establish when construction begins. Another way is a safe harbor based on costs paid or incurred. And if you pay or incurred 5% of the total cost of the project, then the date at which you make that payment or incur that cost will be the date that you are deemed to begin construction. While it's nice to have the safe harbor, lots of people in the marketplace rely on the physical harbor or the physical work safe test because they can substantiate it with photographs and things like that. So people get comfortable with either way. And then in addition to that, once you start construction, you have to continue it, and there's a safe harbor. So you can't start construction and then put it on the shelf for 6 years and then pick it back up again. That won't cut it. And generally, if you get your project built within 4 years, you're going to be in a safe harbor where you will have begun construction. So those are the ways that that's one way you can be exempt from the prevailing wage and apprenticeship requirement, is begin construction prior to that date. Another exemption is for certain small projects. If your project is under a certain megawatt threshold, then it may be exempted from these requirements. Important thing to keep in mind there. Now, as for the requirements themselves, the prevailing wage requirements, all of these the reason we're dealing with these requirements, by the way, is this all comes from a previous piece of federal legislation called the Davis-Bacon Act, which had to do with federal contracts and wages that must be paid in order to qualify for a federal contract and things like that. So that's where all of these concepts sort of come from. And if you happen to be someone who knows about government contracts and how that world works, this may be familiar. But the prevailing wage requirements essentially require that laborers and mechanics employed in the construction, alteration, or repair of facilities have been paid appropriate prevailing wages. Well, what does that mean? Prevailing wages are the wages that are set by Department of Labor, and they look at particular regions of the country, and they look at a particular type of employee, say a machine operator, say a welder, something like that. And they say, if you're in this part of the country and you're doing this kind of work, here's your prevailing wage. So if you pay those prevailing wages and you can document it, then you're good with that requirement. The apprenticeship requirements essentially require that a certain number of percentage labor hours out of all the labor hours that are consumed by the project are performed by apprentices. And then there are other requirements about, different ratios depending on which apprenticeship program you are getting your apprentices from. There are these sort of certified programs that are run by states and other government entities, where if your apprentices are registered in that program and you use them, then, they're qualifying apprentices that you can use. And if you use enough of those hours and you have enough of those apprentices signed up and working on the project, then that requirement will be met. And we'll come back to this. So if you have more questions on prevailing wage and apprenticeship, don't worry, there's more later. Now, in addition to the boost in the credit rate from 6% to 30% that you get for prevailing wage, there are other adders that can provide more credit. Certain small solar and wind projects that are in certain low-income areas can qualify for a certain type of credit adder, either 10% or 20%, depending on what kind of project you have and where you're located. That particular type of credit, though, is more of the is less generally applicable. Only small solar and wind projects, only in certain areas, and that one you have to apply for. There's actually an application you have to submit to the IRS. They review it and say, yes, you're eligible, and we're allocating some of the money for this to you. The other two are a lot more commonly things you'll run into and don't require an application. The first is domestic content, and this in the ITC will get you a 10% bonus, so it'll take you from a 30% to a 40%. And this requirement generally is that your project must include 100% structural iron and steel, and 40% of your manufactured products need to be domestically manufactured. This can be difficult to satisfy depending on whether you can find enough structural iron and steel made in the US. When the rule first came out, the manufactured product component, where you needed to have 40% of your manufactured products be domestically produced, this was a real headache to work through because it involved going through your vendors and asking your vendor, well, how much did it cost you to produce that widget you sold me? And that vendors are unwilling to give this and this information. It can cause a lot of headaches. Now we have a safe harbor for certain industries, for wind and, or I should say technologies. We have it for wind, we have it for solar, for example. And these safe harbors allow you to make certain assumptions about the panels that you purchase for your project. And you will, if they're domestically produced, you can assume that X% of the cost is attributable to things that happen in the United States. So it removes that process of having to go through your vendor and actually figure out how much these things cost. So it's achievable. Certainly there are deals in the marketplace where this has been, people have used this and transferred credits on the basis of it. And then the other big bonus to keep in mind is the energy community bonus. There's 3 ways that you can be eligible for this. You can build your project on a brownfield site. And in order to determine that, you need to go get an environmental study and see if you have a brownfield. The other 2 ways you can get it are based on location data. And there's a mapping tool that you can use. It's a quick Google search away where you look to see if you are in an area that has had certain levels of historical oil and gas activities and also has a unemployment rate higher than average, or if you're an area that used to have a coal-fired power plant or a coal in it and is now retired, or a closed coal mine. So if you're in one of those areas, and again, it's pretty easy to go on the website and check it out, then you're going to have the 10% energy community bonus. So a little bit about how these transfers work in the first place. So before the IRA, it was possible to monetize tax credits, but it was a lot more complicated. The most common way to do it would be to bring in what's known as a tax equity investor, who is not only just buying a credit, because before the IRA you couldn't do that, but they would have to invest into a partnership that owned the project. They would have to become an owner of the project and then rely on the rules in subchapter K, the tax rules that tell you how you can allocate expenses, deductions, and credits to the various partners. Rely on those rules to invest in the partnership and receive credits and other benefits in return. It works. Those deals still happen today, but they are a lot more complicated. They take a lot more time, and you know, they don't work for everyone. So transfers are a lot more simple. They don't require a actual investment into a project. It's just a third-party exchange with a third party for a credit. And we'll talk a little bit more. And 6418 is the code section where all the action happens. So the terms of art that are used are eligible taxpayer and transferee taxpayer. The eligible taxpayer is the credit seller. The transferee taxpayer is the credit buyer. Now, the seller is the one that makes the election to transfer the credit. They do that on their tax return for the year that the credit was determined. And if the seller is, if you are a partner in a partnership, for example, and you receive a credit from the partnership, and you think to yourself in your individual partner capacity, I would like to sell this credit. Bad news is you can't do it in your individual capacity as a partner. You have to look down to the partnership and get the partnership, with respect to which the credit was determined, to make the election to do the transfer. So it's the partnership or an X corporation. If you have a flow-through entity, the entity is the one that makes the election to transfer. The elections are made on the return, on the original return, not an amended return. And you have extensions. You can factor in extensions as to when that deadline is. Here's a list of the eligible credits. You can see there are a lot of them. You can see the big ones: 48, 45, 45X. Those are the credits that are probably receiving the most attention in the marketplace right now. I refer you to this slide on your own time if you'd like to take a look at the full list. So like I said, the credits are determined sort of year by year. So if you have an ITC, projects that are placed in service in 2024 are going to be 2024 credits that are eligible to be transferred. They're also determined by property or facility. So depending on what your facility is, it could be a biogas facility, it could be a solar field, it could be a wind field. In the case of wind, every single wind tower is a facility, so every single wind tower has to get registered. Credit transfers, we can now transfer credits, which is great, but you can only do it once. So any credit that passes from a seller to a buyer, that buyer's got to use it. They can't then turn around and transfer the credit to someone else. You can have a broker that's matching a buyer and seller, but you can't have a broker that is buying the credit and then reselling. And another good thing to keep in mind is that if you are thinking about being a buyer here, once you've signed your agreement, once you've closed, you can take the credit that has been transferred into account for your estimated tax purposes, the payments of eligible taxpayers, i.e. sellers. Most sellers are going to be eligible. The ones that are on this list are not eligible. It's mostly nonprofits, government entities, tribal governments, things like that. And the reason they're not on the list as eligible sellers is because they are entitled to use direct pay for all of their credits, not just for hydrogen, carbon capture, and manufactured 45X advanced manufacturing credit. So consideration, what you're paying for the credit, it must be paid in cash. So that's an important thing to keep in mind. Other sorts of compensation won't cut it. And it's also important to keep in mind that if you have sort of a buyer and seller that are related in more than one way, so maybe they're selling credits, but they're also buying widgets from each other, you need to be careful and make sure that, you know, we're not moving consideration around in a way where you pay less for the credit, but more for the widget or something like that. That could run into a problem for the consideration being sold in cash. The other important thing to know about the consideration is that is the deadline for payment. So if you have a 2024 credit, say you placed a solar field in service in 2024, you have until the earlier of either the seller filing their return for 2024 with extension, so October 15, 2025, or if the year of the buyer in which they're going to use the credit happens earlier, that's your deadline date. So it's either the filing date for the seller in the year of determination or the filing date of the buyer in the year they're going to be utilizing the credit. So you got plenty of time for 2024 credits. Multiple credit transfers. You don't have to sell all of 100% of the credits to just a single buyer. You can sell multiple pieces of it to separate buyers. However, what you need to sell is sort of a pro rata slice of the entirety of the credit. You may not, for example, sell the 10% associated with an energy community bonus or a domestic content bonus to one particular buyer and then sell the rest of the credit to someone else. So multiple credits are allowed in certain situations. And with that, I'm going to turn it back over to Andrew, who will talk a little bit about the recapture rules.
Thanks, Doug. Recapture, as I mentioned, is the idea that some tax authority might look at one of these credits that you're claiming or that you claim to have generated or that you've bought and tell you that you actually don't have it for a number of different reasons, or that you have it, but it was invalidly given to you, and so you don't get to take the benefit of it. This happens primarily in the context, to the extent it happens at all, of an investment tax credit, because a lot of the PTC's production tax credits don't come with recapture risk, but the investment tax credits, ITCs, do for the most part. And so in the context of an ITC, recapture happens if the taxpayer disposes of the credit property. So the taxpayer, in this case being the entity that owns the project that generated the credit in the first place. And if that taxpayer disposes of that project, the energy property that gave rise to the credit, in some way that's impermissible, that could include foreclosure. If you're a developer and you're building this project with debt or with equity, but especially with debt, and the lender forecloses on the project and it changes ownership, that counts to trigger recapture. Or if the project that gave rise to the tax credit fails to be investment credit property. For example, there's a casualty. Some part of it is destroyed. It's not able to operate for the predominant purpose of generating energy anymore, or it's repurposed. It used to make energy of whatever sort, and it's been repurposed, and now it makes energy, or it makes some product that's not in a qualifying category. The recapture risk starts at 100%, meaning if any of these things change, if ownership transfers, if casualty occurs, condemnation even, and that's something I think that people sometimes don't think through when it comes to recapture. But a change of ownership could come about through a government or quasi-governmental taking as well, like condemnation. And if that happens in the first year after the project is placed in service, there's a 100% recapture risk, and you lose 100% of the value of that tax credit. That 100% recapture risk decreases 20% each subsequent year. And that's how you do that math and say, well, after 5 years, there's no recapture risk. After 5 years, that 100% has gone down to 0%. And now if something terrible happens with that project, it ceases to be investment credit property, there's a change in the ownership of it. Now at least the recapture risk is down to 0. Keep in mind, these are general rules. Every credit has got its own unique rules that govern it. 45Q is an example of those, and it's got some special recapture provisions that have to do with the release of carbon that's been sequestered. Remember, 45Q had to do with carbon capture and either utilization or sequestration and storage. And so if you sequester and store that carbon that's been captured, but years down the road, it's released in a way that's prohibited, you risk that tax credit being recaptured as well. Statutes, regulations will impose as well requirements that the transferee taxpayer, the one who makes and is selling and transferring the credit, bears the recapture risk in the first instance, meaning that tax authority is going to come looking to that initial transferor to bear that risk. And so this is a thing that buyers and sellers in credit transfer agreements really negotiate aggressively between each other. Seller is buying this credit, and seller wants the credit to be good. Seller, no pun intended, wants to take the credit to the bank. But a lot of the validity of that credit is very much within the control of buyer. And post-close, seller's not going to have much control over what buyer does. And so buyers and sellers are going to arrange indemnities that have to do with recapture. If buyer causes the project or the capture to be, rather the credit to be recaptured, buyer is going to provide some indemnity to that. And a lot of negotiation goes on with respect to the amount of that indemnity, what sorts of acts are going to trigger that indemnity in the first place, And is there any carve-out indemnity for risk that might land with the buyer? So sellers got the project that generated the credit, sellers who sold the credit, sellers who has got to keep operating that project and maybe avoids recapture, and that's outside of buyer's control. And if I juxtaposed buyer and seller earlier and I was talking, I apologize. But so buyer, knowing that a lot of that stays within seller's control, the onus is going to be on buyer to do a lot of diligence and make sure there aren't unacceptable risk of recapture occurring. And once closing occurs, buyer is going to try to have pushed a lot of indemnity and a lot of covenants and contractual obligations on seller to keep that property able to validly generate that credit and to avoid a recapture risk. Some of that risk can be offset with insurance. Buyers often are looking for tax credit insurance. It can insure against recapture risk. Some of these products can insure as well against the risk that things like prevailing wage and apprenticeship requirements aren't met. But it's going to add cost to the transaction, and it's going to add complexity to the transaction as you go through insurance underwriting and securing an insurance policy. Recapture isn't the only risk that's out there lurking. There's also such a thing as an excessive credit transfer penalty, which basically means that the seller of the credit, the generator of the credit, has sold you or has somehow transferred or passed to you more than that credit is worth. You got a $100 credit and you sold it to me telling me it was a $150 credit, and really it's not. But I bought it as if it was a $150 credit. So in that case, the amount of the excessive credit transfer, that gets added back to the buyer's tax liability. So you thought you were buying your way out of some tax liability. It turns out you didn't. That gets added back to your tax liability. But here's the kicker. You also get a 20% penalty. There is some defense to that penalty if you are the buyer, showing that you've made reasonable efforts, you've done diligence in a reasonable way, that you didn't think you were getting an excessive credit transferred to you. So if you're the buyer, some things that you really want to confirm in your transaction agreement and that you want to have evidence, that you've done and looked at, is all of your diligence. You want to show that you acted reasonably. You want to be able to say to a taxing authority, look, applying a reasonable lens here, what a reasonable buyer would have done in the same or similar situation. I really, really did and reasonably think this was the value of the credit I was getting. I'm relying on third-party expert reports, and they come from reasonable, credible third parties, and I was within my rights to rely on those. I've relied on sellers' representations, and I've looked at financials. In the case of an ITC, I've looked at the cost seg or whatever it might be. I've done whatever a reasonable person would have done to think that I was not getting more credit than I was entitled to get. Pricing considerations. We mentioned earlier, and I'll go back and hit these again, but the less risky credits, the ones that aren't subject to recapture, are going to fetch a higher price. There's less recapture risk, and so there's less risk you're going to pay for something and not get it. And so those are the ones that are going to fetch more like 93 to 96 cents on the dollar. Ones with recapture risk, that's where you're more like 80 to 93 cents on the dollar. ITCs and 45Q carry recapture risk. Most PTCs do not, although that's not a hard and fast rule. An ITC for a project that's been placed in service already is less risky than the ITC for a project that's not yet been placed in service, because the ITC is generated when the project is placed in service. So if you got a project that's been placed in service, you know that ITC exists. If it's not yet been placed in service, there's some element of risk that for whatever reason placed in service might not occur with respect to that project. Again, tax insurance can help mitigate this risk, but it's going to increase transaction costs. There are, as you go through the term sheet and your transfer agreement, there are some provisions to keep in mind to make sure you set the table for these things in the future before everybody signs, on the final page. Indemnity, buyer is going to be looking for indemnity to cover its tax liability. If you bought a thing seller said they had to sell you and it turns out that thing wasn't the thing you bought, you want indemnity for that. Specifically an excessive credit transfer penalty, any interest on that. If seller said they were selling you $100 credit and it turns out it's valued at 75 bucks, you want that indemnity. And you want it specifically on an after-tax basis, meaning when you make an indemnity claim as a buyer and seller gives you some money to pay that indemnity claim, and that money seller gives you, if it's included in your taxable income, then you're paying tax on this money that seller has given you to make you whole. And so the money you have to make you whole is decreased by the amount of that tax bill. And so the after-tax basis means not only is seller giving you this money to make you whole for an indemnity claim, they're giving you some on top of that to pay the tax that's going to be owed on that indemnity payment. Sometimes that's called a tax gross up. But the idea is that your indemnity payment, if you're a buyer, comes on an after-tax basis. Seller, if you're a seller, you're obviously looking for an indemnity cap, same as any agreement under the sun. You want limited liability out there. Seller is going to push for the lowest cap possible. Sometimes that is the face value of the credit, although that's typically not an adequate limit because that's not going to include penalties, fines, fees, interest, attorney costs, and so forth. Some percent of the face value is more like it, 100 and X percent, if you're looking for some reasonable thing to base a cap on. Transaction costs, these are really sort of who's got leverage and who needs the deal more than the other. Might push some of their costs onto the other party. 75% of the time, probably, if not more, each party pays its own costs. If one party really is getting a sweetheart deal or wants the deal more than the other, that party might kick in part of the other side's transaction costs. With that, let me turn back to Doug for diligence considerations.
Thank you, Andrew. In the interest of time, we have a lot of material. I am going to cede my remaining slides over to the Baker Tilly team because they're going to be covering those topics anyway. So with that, and by the way, we see your questions coming in. Thank you very much. We're going to try and get to them at the end, so please keep them coming. We will either answer them on this webinar or follow up after.
Hi, everyone. Thanks very much, Doug and Andrew. I'm Gideon Gradman. I help lead the energy and infrastructure team at Baker Tilly. And I have two of my colleagues on the phone here. I'll let them quickly introduce themselves as well, and then we'll get into some more material.
Hey everybody, Dave Gibson. I manage our tax credit syndications platform.
And then, hey guys, Bob Hofacker, tax director here with Baker Tilly. Much of my time is spent in the renewable energy space. So I think as we get started on our portion here, I think Doug and Andrew both covered, the general compliance pieces and the considerations that we need from our requirements perspective overall. I think we'll focus more on, the solutions we've kind of developed through Baker Tilly, how to help you meet those project requirements, and then kind of get through the due diligence process, whether you're monetizing the credit or going through a sale. So the Inflation Reduction Act, as Doug and Andrew kind of both mentioned, it really opened up the landscape, and there's essentially three ways that now all entities can really monetize the ITCs or the PTCs. Obviously, the old way and the most efficient way is by owners actually using the tax credit against their actual tax liability overall. So there's no discount on sale, no time value of money waiting if you're trying to transfer or wait for a direct payment. Then there's the transferability way, where you can actually sell for cash. And then the new way, kind of adapted by the IRA, is for these tax-exempt owners, where they can actually receive a direct payment from the IRS. So when you think about those three different ways you can monetize the diligence process and the compliance requirements behind them, you're really looking at different diligence processes and different diligence requirements overall. So I think Baker Tilly has kind of adapted a program to kind of fit all of those needs. We like to walk through this slide because it kind of does a good job of summarizing what Andrew and Doug all walked through and really showing that the base credit on all of these projects is really only that 6% normally. So there's significant compliance reporting requirements behind the 30 or 40% credit that we're used to seeing on these projects. So when you look at transacting on them or taking a tax position on a return, there's a lot that goes into claiming the 5 times multiplier, claiming the 10% adders. And it's not really just a reliance on reports. There's diligence that has to go above and beyond that.
To jump in here, I think it's important to realize that for any credit, there's essentially 6 pieces of information that need to be substantiated on the tax return in order to generate these credits and substantiate all the bonus credits that we've talked about so far. You have to establish, number one, do you have eligible property? Number two, when was the date of the beginning of construction for the project, which drives a lot of different compliance requirements within these different bonus credits? When is the date of placed in service, which also drives eligibility for a number of these bonus credits? And then if you're going for each of the bonuses, have you met and substantiated the prevailing wage and apprenticeship requirements? Have you done the same for the domestic content requirements? And have you done the same for the energy community requirements? Each one has its own compliance data requirements that you need to be able to show, both to claim the credit on your own tax return and to get a buyer comfortable with purchasing a credit if you're looking to transfer that credit. I find this to be it's busy but useful. This is the way that Baker Tilly really thinks about compliance holistically. And I think it's helpful for both developers and buyers to understand what goes into a substantiation for a tax credit. I'll say you should focus on the left side of this slide. I'm going to go through it. Baker Tilly really takes a phased approach when we're helping clients and working with clients that who want to build a project and then get those tax credits substantiated. And we take an approach sort of from the pre-construction phase all the way through the placed in service and monetization phase, and build that substantiation package over time. So initially, pre-construction, we suggest you start what we call our phase 1 and 2, but essentially understanding generally what is the project's eligibility for the credit. Are they trying to get a credit under Section 48 or Section 48E, for example, if they're making electricity, or some of the other tax credits that we've discussed? Have they met the basics of establishing that they have eligible property? When do they think they're going to begin construction? When do they expect to be placed in service? And what are they targeting to achieve in terms of the bonus credits? Similarly and concurrently, if you're focused pre-construction on meeting things like the prevailing wage and apprenticeship requirement and the domestic content bonus, it's important that you get very quickly involved with your vendors and with your contractors, because at the end of the day, the taxpayer is responsible for substantiating these credits, but the work often comes through their vendors, so through the EPC and their subcontractors, or through your equipment vendors, who need to be taught and understand in many cases what's required, what's the data that they will need to send to the owner of the project, and that owner of the project may work with us or other service providers to be able to tabulate whether they've met each and every bit of the prevailing wage or apprenticeship requirement, and have they established, for example, the origin of all their domestic steel for structural steel, or have they substantially been able to show the manufactured cost of products that's required under the domestic content bonus. So during this second pre-construction phase, we also spend a lot of time working with and training vendors, which I think any developer needs to understand. That's a step that needs to be budgeted for and needs to be thought through in your timeline. Third, you want to establish the eligible basis. So that's really the cost segregation exercise. This usually occurs at the end of a project. You might do an estimate before and during the project while the construction is happening. But at the end of the day, the final costs from all the vendors have to come in usually 60 to 90 days after a project is placed in service. They have to be tabulated and put into a schedule of values, which is done during the cost segregation step. And then that becomes the base schedule, the basis upon which the percentage credit is applied to. So again, a key piece of data that needs to be part of any compliance exercise. And finally, you want to put together the full set of work papers that's required to substantiate the credit. No different than substantiating the home office deduction on your personal tax return. You need to make sure that you have all your receipts, you could say. So have you established the prevailing wage for all the different types of construction trades at the site for your county? And made sure that they met the federal requirements? Have you met the apprenticeship requirements? If you're in an energy community, have you not just looked up whether the site appears on a map, but have you actually substantiated how that site is eligible? Is it in a formerly a statistical area, or in a census tract, or on a brownfield that meets the requirements, and how are those requirements met? And the same is true for domestic content. So we suggest that you go through the full documentation exercise so that when you're done, you have a a sort of a binder, a work paper package that you can use in the event of an audit, so that you are fully comfortable with the fact that you're claiming what is a large tax credit. And finally, you can work through the monetization effort, which we've begun to talk about already. Bob, you want to cover these items?
Yeah, I'll just be real quick here because Doug kind of went through it, but I think that the key emphasis on begun construction, we've seen this as a risk area on a lot of projects, not because it hasn't been met, but because begun construction impacts a lot of different things on a project. So as Doug mentioned, the PW&A exemption going back to January of 2023, it's very important. Obviously, coming up to the year end here, the 48 credit and 45 credit expire for projects that do not begin construction prior to year end. And then it also impacts the energy community bonus and actually the direct pay elections overall on a timing perspective and on the ability to meet domestic content for the direct pay project. So very important step. Documenting while you're doing it is obviously the cleanest and the most easiest way to kind of meet the begun construction requirements overall.
Thanks, Bob. I think that the biggest change that the Inflation Reduction Act brought to the industry is the implementation of the federal prevailing wage and apprenticeship requirements. I'm going to go through this relatively quickly, but it's important to understand that there is prevailing wage and there is apprenticeship, and each have their own requirements, and both must be met throughout the construction, alteration, and repair phases of any project that's looking to get the 5 times multiplier bonus credit. For the ITC, it needs to be met during construction and for 5 years after it's placed in service. And for a PTC, it has to be met during construction and for the 10 years following placed in service. And the apprenticeship requirement has to be met during construction, but not during alteration and repair. Baker Tilly, again, had put together a bit of a compliance program to think about what is a very onerous and complex substantiation process to show that you have met this requirement. In general, you can think of a solution really as substantiating the interplay between prevailing wage, apprenticeship, and then understanding what compliance penalties may occur and how can those be paid timely so that you stay in compliance. In general, prevailing wage is the wage for every applicable trade in the county in which your project takes place. You need certified payroll reports to be provided by all the vendors. So as I said before, you want to make sure those vendors know what they need to produce so that they can help you comply with these requirements. And Baker Tilly and others, but Baker Tilly has put together a way to really process that information efficiently to be able to receive those certified payroll reports, identify when there may be gaps or there may be inconsistencies or incorrect pay during a pay period, and quickly flag it so that it can be rectified within the cure period. Similarly, with apprenticeship, there's 3 levels of apprenticeship tracking that you need to understand. There's the labor hour requirement, which is how many total apprentice hours need to be logged as a percentage of the total for a project. There's a participation requirement, which where every vendor needs to have a certain minimum level of participation. And there's a ratio requirement, which is on a daily basis. Have you met the ratio requirement between apprentices and non-apprentices to make sure you can stay in compliance there? The goal here is to ensure that apprentices are used often and at the right ratio throughout the project. And finally, if there are penalties for non-compliance, which is common, mistakes happen, then it's important to understand what those penalties might be and how do you cure those so that you can avoid any sort of maximized or excessive penalties. You can learn more about the way we work on this for clients. There's many ways to approach it. I'll let you look this up on your own time. You can use the QR code there, but it's something that Baker Tilly spends a lot of time and effort to really help clients understand this complex requirement so that you can meet it and make sure that you're confident in your claim for the 5 times multiplier, which is the biggest impact bonus in the Inflation Reduction Act.
On the domestic content side, Doug touched on a little bit of this, but generally, I think that the first step here is really breaking down your project into applicable project components overall. And that's a defined term within the notices that have been released, but it's really breaking out construction materials, structural steel, and then manufactured products. And there's really 2 distinct tests here when you're looking at the domestic content bonus. So your structural steel bucket really is an all or nothing test, right? So anything structural on site that is not a manufactured product is going to be either 100% in compliance or not in compliance. So if you have 100% US steel on your project, you've met that first test. The other test is then looking at your manufactured products. And this is where you kind of have to unveil your manufacturer's cost, essentially. Once you've identified your manufactured products, you're looking at the component level of those. So not going to the subcomponent level or, 2 or 3 tiers down from that. It is really where the components are manufactured and the cost of those components building up into your total manufactured product cost. For projects beginning construction before 25, that test is 40%. So I think it's a detailed analysis that really involves, the whole supply chain here on the equipment side, which makes it, very difficult on those non-safe harbored technologies overall, and really requires cooperation on their end. So that's a bonus you're looking to pursue. Very key to involve everyone up front. Our compliance program, to an extent, really looks at identifying the manufactured products on each project and working with those vendors, getting an NDA essentially where Baker Tilly acts as a safe harbor for that information. And then we would issue essentially a report that identifies the total manufactured content overall. With that report, we're obviously certifying that all of the steel is U.S. manufactured. But again, our compliance solution, you can learn more about that, but really requires the full supply chain to be working with you.
On the energy community bonus credit, this is the third piece of the bonus credit opportunities. As Doug mentioned, there's 3 ways to qualify for the energy community bonus. And these are meant to focus on areas that have historically had a lot of traditional oil, gas, and coal production, because there's a recognition that as the nation moves toward clean energy solutions, these regions that have traditionally always produced oil, gas, and coal, or that may have a significant contamination history in brownfields, could potentially lose out in job opportunities over time. And so they want to give an extra opportunity for these communities to get additional projects by giving them additional tax credits. So there are ways to meet these requirements. One thing that might be useful, Baker Tilly has an energy community mapping tool on our website, which we find very valuable, both internally and externally. That goes into, you can type in an address and you can see whether or not something may qualify for an energy community bonus and follow up if you want more investigation into those sites. And I think overall, just thinking about it from a comprehensive basis, Baker Tilly and many, approaches this the way we might counsel a project owner. If we were your auditor, what information would we need to comfortably file your tax credit with confidence, so that we know that the tax credit is valid and is substantiated? And we take that approach when we go through the process of substantiating these credits. We've gone through the compliance requirements quickly here today, and I think just understanding that each of these compliance requirements have its own set of documentation that has to be handled, and it's important to consider that as you develop your project and look at the sector. And I'm going to turn this over to Dave to talk a little bit more about the Renewable Energy Tax Credit Fund, which is beginning.
Thanks, Gideon. So this is a question earlier. We provide multiple monetization solutions for sellers, services for buyers as well. In particular, we have a robust platform for brokering transactions, matching sellers with buyers. Through that work, we believe there continues to be an opportunity to improve both access to the marketplace and efficiency of deal execution for both buyers and sellers on the smaller end of the market, generally under $20 million in tax credits. And that's why we're excited to announce the launch of our Renewable Energy Tax Credit Fund solution. Through our fund solution, what we're doing is we're marrying our compliance services that Gideon and Bob have talked through with our tax credit syndications and capital markets functions to what really will aggregate sellers and buyers in series funds that are targeted to individual tax years. So we will, through the solution, we will originate, underwrite, asset manage transactions on behalf of a pool of buyers based on buyers' subscriptions for each applicable tax year. So whether you're on the buy side or the sale side, if you're interested in learning more, I'd certainly love to connect with you. Let me turn it back over to Doug, right, or Andrew to wrap us up.
I appreciate it, Dave. Thank you. I know we've got a number of questions that have come in through the Q&A. I think we're right at the end of our hour here. So we will get back to everyone who sent in a question by email and look forward to talking with all of you. If we can answer any questions that didn't come through in the Q&A chat, or if you'd like to talk about anything further or what your organization might be up to or be interested in, any of us on this webinar would be thrilled to talk with you. Look forward to hearing from you. And that all said, thank you very much for joining us today. I hope it was useful and informative, and we'll look forward to getting back to those of you who put questions through. Thank you.